Hello and welcome everyone to the Capitalmind Podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capitalmind may maintain positions in the securities discussed in this podcast.
Hi everyone. So we're doing something different this time. We have a video set up and you're looking at the Capitalmind podcast in video. Let's see how this experiment goes. In today's episode, we're going to talk about the evolution of the stock market and how we feel equities as an asset class are positioned over the years or maybe even decades to come. And perhaps more accurately or more granularly, we're talking about the asset management industry and how different vehicles like an AIF, PMSs, mutual funds and the like are likely to grow in the years ahead. So do listen in and let's hear what Deepak has to say. Hi everyone, I'm Shrey and I'm with Deepak Shenoy, the founder and CEO of Capitalmind. Deepak, we are very clearly in a bull market. I got a call this morning saying I have a few crores lying around. I have a few months before I need them. Where can I invest it and what can I do in the next couple of months? These are not calls we used to get 6 months ago. So here we are, bull market territory firmly established. But one thing that came to mind to me is this bull market feels a little different from the investor behavior point of view, because if I think of the last big upsurge like this, which was, I guess, the COVID one or the post-COVID one rather, a lot of that was based on, let's say, do-it-yourself kind of investing. It was people either looking at managed portfolios online and then buying access to that or basing it on tips, so on and so forth. This time it does feel a bit different. And this actually got me thinking, maybe equity investing is truly just the future and that's here to stay. And I want to get into that as well. But perhaps more granularly or more specifically, do you feel that managed vehicles like the kinds we run or that are out there are the ones that are going to benefit from this bull market on the face going forward? Or do you feel that do-it-yourself investing or other types of investing are going to be equally competitive as they have been in the past? So maybe I'll just hand it over to you. Who owns our market right now? How much of it is direct? How much of it is through these vehicles? And how do you see this evolving a bit over time?
So, Shrey, this is actually a very interesting time as well, because we seem to have switched from tradition in a way. Traditionally, India has been a very promoter-owned market. So, for instance, because of legacy issues and lots of things, 50% of our companies are owned by the promoters of those companies themselves. The promoters here being the founders or the founding families.
And this is still.
This is even now.
Yeah.
So, about 49 to 50%, whether it's the government, which owns 50%, for instance, in all the banks, in all the OMCs like BPCL and HPCL and so on, by regulation, because they can't be called a public sector enterprise unless the government owns 50% in them. They also own 33% in Vodafone. So we'll ignore that they're not a promoter in Vodafone. They had to buy it pretty much because Vodafone was otherwise gone, belly up. But interestingly, of the remaining 50%, it has almost always been that foreign institutions, which were only allowed in India in 1991, and Indian markets have been there since I don't know how long. We are seeing those people own about 50% of the non-promoter market, which is 25% of the overall market. And then that has slowly, over the last 10 years, come down to roughly about 18% now. So that means, 18% of the total, which is 50% promoter and 18% of whatever's remaining. There's an 18% ownership of foreign institutional investors. Retail individual investors own roughly 9% of the market.
Okay.
Now, this is, to give you an idea, this is about 360 trillion rupees, 360 lakh crores. That's the total size of the market. So if you think of it as 9% of it, that's roughly 30 lakh crores. That is 32 lakh crores that is owned currently by retail individuals. Mutual funds own 8%, so about 25 to 26 lakh crores. Now, mutual funds are a different beast, but they own lesser than retail investors so far. So
What about larger vehicles like the ones we run, like PMSs and AIFs? Are they also, or they come under the direct?
So here's where it's so because 18 plus 9 plus 8 does not add up to 50, which is the remaining, this thing. It's this split between banks, financial institutions, brokers, prop accounts. So businesses that own other businesses and so on, those kind of own the rest. But here's the interesting part. Okay, so the PMSs are actually conduit, since we actually hold our customers hold shares in their own accounts, so they will be classified as retail individual investors or high net worth individual investors because they actually own the shares in their account. And AIF, on the other hand, is a pooled vehicle, so it is an institutional vehicle, so it will be of the order of a pension fund, an insurance fund, and so on. Again, insurance companies, to give you a rough example, LIC has about 50 lakh crores worth of assets, of which only about 8 or 9 lakh crores must be in equity. 8 or 9 lakh crores adds up to today about only 3% of the overall. So if you look at insurance added up, it's 8% for mutual funds, 3% for LIC, another 2 or 3% for the remaining insurance industry. So it's relatively a smaller part than FIIs, even if you combine all the institutional Indian vehicles put together. And retail direct investors, of course, which includes PMSs. PMSs, I think, have about maybe 3 lakh crores in assets under management in equity. There's more in debt. But 3 lakh crores in assets under management would be less than, 10% of the total overall, retail assets. So I don't think that they're a big blip in that. It's mostly the ownership by individuals themselves that is a significant part of the market.
I think the number that surprised me of the ones you listed was actually the mutual fund one, because as someone who's been watching the industry for the last 10 years to some extent, and at least seeing the ads on TV, it seems like the most compelling solution you have. There's only a management fee. There's no performance fee. There's basically no taxes even today. There seems to be a lot of trust, and they're fairly heavily regulated, and they've done well as well. So I think what kind of puzzles me is why that number is still so lower than retail participation directly. And has it always been low, or this is just a current blip in the...
That's a great point. See, in the US, for instance, just mutual funds own $22.7 trillion. $22.7 trillion is probably roughly half of the overall market cap of US companies, 45.
But their mutual funds started in 1930 or something.
Yes, right? Merrill Lynch had its first ad out for retail mutual funds in 1930. But since they've got so much time, but still they're a significant owner of stocks in the US. There's ETFs, which has about $7 or $8 trillion. So institutional vehicles in the US probably own 95% of the market, and retail individuals probably own relatively a smaller amount directly.
And I guess the founder component is much smaller there, the promoter component, yes. If they even have it.
Very little. They don't consider that a big deal. It's no problem for, say, a Facebook to have only a 5% ownership by, or 2% ownership by, say, a founder.
I think he owns 20, but
he owns 20, but in Facebook it is higher. It's probably one of the highest. But I don't think Google and all of them, they have quite as much. But in India, it's the exact opposite. So if you consider founders retail, then of course they own a significant chunk. But of the non-founder population, we don't have it. Yeah. And this has actually come about because India has always been a very high retail market. Roughly 30% of intraday volumes in the market come from retail individual investors. Only 1% in the US come from individuals. So we are a very heavy, like Korea is, I think, as well, similar as a concept. And mutual funds are also effectively retail investments because you entrust your money as a retail investor to a manager who then takes it, pools it together, and then invests it on your behalf effectively. But they are tax advantaged. So the surprising part about what you mentioned was, how come these guys don't have more capital? Simply because don't they pay, for instance, a mutual fund buys and sells a stock, there's no tax. Whereas you buy and sell a stock, you pay the tax, and only on the remaining amount you get to reinvest, so wherever you do. So in a way, mutual funds are tax advantaged. When mutual funds receive dividends, they pay no tax. When you receive a dividend, you have to pay tax.
A very high tax.
10%. It's actually
income.
10% deducted as source, and then it's taxed as income. So whatever else, if you're taxed at 39%, you're going to pay the remaining 29% at a later point.
So it's basically like salary.
It is like a salary. So your dividend is now considered income. But this was not always the case. In 2005, things changed. And what happened at that time was the mutual fund industry was very nascent. And during that time, we saw the launch of a lot of mutual funds directly investing into equity. But at the same time, the government switched the entire regime to saying, let us reduce the total overall taxes on. In fact, they brought the taxes down to zero. They said there's no dividend tax. The companies pay taxes and then pay dividend. So technically, there will be no more tax. But on the dividend itself, there was a 20% dividend distribution tax put in. There was something called STT that was introduced in 2005, and they said instead of taxing you on the gains you make, let's just tax you on the transaction values, a very tiny percentage, 0.1 or 0.01% and so on. And instead, we'll earn our money that way. Why should we wait for you to earn a profit and then make some tax, you pay some taxes on those profits and so on? It was cumbersome at the time, and India's tax system had not evolved to be extremely well electronically monitored as it is now. So 2005 was when that changed. So then there was no advantage for you to invest in a mutual fund versus investing directly. I could buy the Reliance stock, and if I give it to a mutual fund and it bought Reliance stock, why am I paying the manager a fee to buy a stock I wanted to buy anyways? Why don't I just buy it directly? So mutual fund investments got not as much a fillip at that time. In the sense they did see a large growth in AUM, but retail investors also invested quite strongly and directly into the market.
So there was like a rising tide moment. I mean, everything went up, and so therefore the mutual fund sector also went up.
And slowly there was a bunch of things that started to work in their favor. Now, at that time, mutual funds marketing was primarily through distributors. There was no organized marketing. Of course, there was marketing in the sort of saying, please buy our NFO. Reliance Mutual Fund at the time, which was called Reliance, now it's called Nippon. Reliance Mutual Fund at the time decided that it will launch 4 different equity funds which were all doing exactly the same thing. So there was a Reliance Growth Fund, there was a Reliance Vision Fund, there was a Reliance Equity Fund, and there's a Reliance Long-Term Equity Fund. So I don't know whether the equity fund was supposed to be a short-term equity fund because they didn't call it that. But the idea was they were all 4 of them coexisting at the same time, doing roughly the same kind of investments, and all created because when you go to a distributor, he says, what do you have new for me? So the guy says, okay, you want something new? I'll make something new for you. It's the same thing. I'll just call it something new. It was allowed at the time. So there was that kind of marketing that was being pushed. But what would happen is, and we saw this in, say, a Reliance long-term equity fund. Long-term equity fund was a closed-ended fund, so it was locked for 3 years. But the equity fund itself raised 5,000 crores, and within a month they lost 1,000 crores because people invested and instantly redeemed because they looked at it as more of a short-term kind of investment. Fees were very, very high. There was 2.25% entry load. So when you paid 100 rupees, only 97 rupees or got invested. Then there was relatively high management fees, a lot of opaque layers of fees that were...
There were no direct plans.
So you could not avoid a distribution fee, whether you went directly or not. And it was very early days. I remember once when I invested in a fund, my money was returned after 30 days because they decided there was something wrong with my application. So they got to keep the money for 30 days until... and then I didn't get any interest or anything out of it. So it relatively, the industry itself was not very,
bit Wild West.
Bit Wild West. So people were like, dude, instead of doing all this, why don't I just go to the direct stocks and just, don't worry about things. They would send you checks when you redeemed a mutual fund. They would send you a check, not directly transfer the money into your bank account, which is what happens now.
I do remember getting dividend checks till fairly recently.
Dividend checks continue to exist. That's usually because if they don't have your bank details, they send you this thing. But now the mutual fund industry has ganged together and said, listen, you need to already have a bank account registered with us before you start investing. So we'll only pay electronically. But earlier they would send you a dividend as the redemption as a check. But that was helpful for the mutual fund, not for you, because when they sent you the redemption, it was on a certain days in Navy. You would receive the check 2 days later, you would cash the check 2 more days later. For 4 days, they're earning the money or the float or the interest or whatever it is during that period of time. But somebody is.
So they had the upside.
They had the upside.
So this sounds very negative. I mean, this was not a particularly great industry, or compared to where it is today, back in, what are we talking, mid-2000s?
Mid-2000s. And honestly, that was the point where people mistrusted mutual funds to a certain extent. So there was not that, major of a rise. So anytime markets would rise, people would start booking profits in their mutual funds, in the stocks as well, but in the mutual funds even more often, because they were like, let's take it. There was no fear of distributors. They would be like, churn your funds, fine. If you made 10%, fine. There's a 1% exit load. You still make 9%. Take it. It's better than an inflation that you've made in. So the exit load would then pay everybody in the chain, and everybody was happy. And there was a lot of money being made, except I think the problem was also that investors were making truckloads of money. For the first 10 years after 1999, average customer returns on, if you had stayed through that distance, was 20 to 25%. Some of the funds made 30% annualized returns in those days. And it was crazy. But still, retail investors were ruling the roost. So till 2013, I think 2013 is when things actually changed. 2013 was roughly, if you just mapped in all the inflows to mutual funds and all the outflows at cost, that means the amount of money that flew in them, there was a net zero number at 2013.
Okay.
Today, that number is net 2 or 3 lakh crores, significantly higher. But till then, the number was zero. And the number being zero has a very clinical problem to it, which means that as soon as the markets went up, people would take out their principal and only let the gains stay. So the AUM at that time was consisting of mostly people's gains, not anything more than that. But something changed in 2013, and that, I think, switched over at another time, 2018. So 2013, we saw the data switch into people saying, listen, we got to invest in mutual funds, and there are good reasons for it. We'll probably come to that later point. But the ownership of mutual funds at that time, even 2017, was only 3 or 4%
of the total market.
Now that's gone to 8%.
Yeah.
And 2018, what changed was that the government reintroduced capital gains tax for direct investors. So you, as a direct investor, you would pay tax if you bought a stock and sold it. But a mutual fund did not pay tax when it bought and sold a stock. So if you stayed invested in that mutual fund for a long time, you could avoid the incremental taxation that would happen in the middle, dividends that would get taxed and so on, which dividend taxation was introduced in 2021, I think, or 2022. Both things were basically making direct investments a little less favorable than mutual funds. Combine it.
So this is a deliberate move, right? I mean, obviously the government would obviously prefer more tax revenue whenever it can get it. But what you're describing seems to be a if I may put it, a well thought through decision that let's discourage this type of investing in certain ways and encourage this by, would you agree with that? In other words, was this the intent to encourage, say, certain types of investments over the other?
I think, the government actually gets influenced a lot by perhaps the way things are put in social media and stuff like that, in the sense of they thought that people are making money in stocks and they're not paying any taxes.
Why is this correct? Yeah.
Why? How can you make so much money and not pay any tax? And then why is this bad? And to a certain set of arguments that actually is reasonable. Now I'll give you an example. This argument was used to bring taxes on foreign institutional investors. So everywhere else in the world, other than India and maybe Argentina, you have something called source-based taxation. That means you actually are taxed in the source country from which you invest. So if a US investor invests in Norway, Norway doesn't charge that US investor capital gains tax. But when the US investor sells, he pays taxes in the US, which makes sense because he's resident of the US and he's paying. So in India, if a foreign investor invests in India and then sells stocks, they have to pay Indian taxes and then claim as a treaty benefit tax. Now, this happens in dividends and interest. Dividends are taxed in the destination country only, even in the US, even for other places. But capital gains are usually taxed at the source. So, for instance, if you come from Singapore has no capital gains tax. You don't pay any Indian capital gain. You would not pay any. A Singapore investor investing in the US would pay no US taxes and pay no Singapore taxes because there aren't any. So technically, they would completely avoid capital gains tax. The same Singapore investors, when they came to India, were like, listen, why are we getting taxed in India? So at that time, there was a bit of a disfavor. And one of the reasons why this tax was introduced was because they said, how come Indian investors are taxed on their capital gains versus no taxes for foreign investors? And that taxation was brought in. So now when the thought process came around, for retail individuals, it was like, oh, why don't we introduce this as a long-term capital gains? Because guess what? If you build a business and sell it and it's not listed, then you pay 20% tax. That's always obtained because only listed companies were given this exemption on taxation, right? So they said, if it is going to be taxing, if we can tax you on the fact that you make gains in a private limited company, why should we not tax you on gains you make in a public limited company? Which is fair to a certain extent, because the idea of lower tax was to encourage investment in the stock markets, and the stock markets got their investment. So to that extent, yes. But I think the thought process of whether taxation should continue to apply, it now just favors the institutional investors who don't have to pay taxes, not foreign, but domestic. So insurers don't have to pay taxes. AIFs do have to pay taxes, unfortunately. That's the downside of having a dual institutional framework. But mutual funds don't have to, pension funds don't have to. So they can keep investing without any tax implications on their investments whatsoever.
So this is very compelling. I think two things came to mind. I'll just bring it up. First is, I remember discussing with you that there's some factors which may have contributed to the increased investments in equity, but I don't know if they directed towards one thing or the other. So I'll bring that up. And the second thing is about mutual funds versus the others. So the first thing is there's been an improvement in regulatory frameworks. I think our rules have just got stricter around both the market, the ability to manipulate the market has come down a lot, and companies and their disclosures and the efficiency. So there's, like, if I may say, just an increasing regulatory, what's the right word for it? Competence, clarity, whatever.
Yes.
That's one.
Trust.
Then you had brought up about the relative lack of attractiveness of gold and real estate. I mean, obviously they exist and will continue to exist for pretty much forever. But as a place to grow your wealth in a medium term, they're not always as attractive as they used to be. And then, I think all of these three, however, they exist as much for the whole asset class of equity rather than just one of the ways of investing in equity. So I just wanted to say, do you think these have influenced meaningfully? I mean, how much is the downside to investing in, say, gold or real estate? That's one. And the second thing is, things do feel different now. Is it just all taxes? Like, in other words, you're not, buying a basket of 10 stocks online because of taxes, or is there something else going on here?
Of course. I think there's a whole macro equation to this whole thing, and that will let me elaborate. But first, let me focus on this. Let's start with the macro theory that in the past, almost everything in life was about investing in real estate and gold. That was the idea. If you got money, please buy gold. If you got a little more money, please buy real estate. Oh, the stocks thing, it'll come and go. It's a fraud. It's a scam. That was the thought process of the past. So for instance, when my father used to invest in stocks, and he invested even before the big scam of 1992 and then after it as well, people were a little like, listen, this guy invests too much in stocks. He should, he doesn't. But to be fair, I think what he did at the time would have made him, or had made him, significantly higher returns on anything that he would have done on the real estate end as well. In fact, he was able to pledge his stocks to get enough cash to take a loan to upgrade the house that he had bought, because the house cost spiraled out of control at that time, and he wouldn't have been able to get an incremental home loan. So the idea that real estate and gold are big have been ingrained in us. Even today, when I tell people gold is not such a great investment,
you get a lot of hate for that.
I get a lot of hate for that. Oh, you don't know what gold. Oh, women like to wear gold. But wear is different from invest, right?
Invest.
So but the thought process is a very different concept compared to where we are now. But here's where the clue is financially. People have started to realize this. You buy a house, you pay 7% stamp duty. And when the person who's you're selling it to, let's say you sell it to that person in 5 years, that person also has a 7% stamp duty. So technically, the stock has to jump at least 7%. The house has to jump at least 7% in value just for you to break even, because there's costs more than 7, maybe 7, 8, 9, 10%. Now you might say, 10% is a given in 5 years. But 10%, if you're going to grow at, say, the Indian economic rate of 12%, 5 years, you should roughly be 100 rupees should become 190 rupees, right? So you're not trying to get 100 rupees to 190 rupees. You're actually getting 107 rupees to 190 rupees when you sell, because the exit taxes will be taken by the next person. Your rate of return comes down. The spread effectively reduces to this. Plus, then there is the pain. If you try to sell a house, it is so painful. You're going to deal with brokers and lawyers and plumbers and I don't know what other kinds of, different sets of people. And at some point in life, this entirely it puts you off as saying, listen, I'm going to do this once, but I don't really want to do it a lot of times. You may get successful. Some people do get successful and enormously successful in the beginning. But by and large, when you look at the large population, they're like, dude, this is, and plus the ticket size. So to really invest in real estate, you need like 50 lakhs, 1 crore plus. And how many such opportunities are you going to get? So if you're a normal person, you'll collect 50 lakhs over a period of a few years. So after that, to buy another house, you have to wait for another 3 or 4 years to be able to buy it, because of course you can take loans and all that stuff, but loans have leverage issues
And then they eat into your return,
disposable income and all that. So you have that. Gold has a similar problem. A spread of gold is like this. People think gold is great, but here's the thing: you go to a jeweler and try to buy gold directly, he'll sell you gold at 5% above the current market rate. And if you immediately take that gold and say, can you buy it back from me? He will buy it from you at 5% below the current market rate. So there's a 10% spread, and they call it making charges, this charges, that charges, such drama. But whatever it is, it's a 10% loss at the time of entry. If you have a house that loses 7% at the time of entry, if you have a gold that loses 10% at the time of entry, not very attractive. People have figured it out and said, listen, what is more efficient? And you know what? Can we get something that A, has a lower cost spread from between buy and sell, and B, I can sell in incremental point. So if I have 50 lakhs and I want 10, I'm not going to sell a bathroom. I'm going to have to sell the whole house, right? Here, if I have 100 shares, if I need a little bit, I can sell 5 shares and 10 shares. So you get that from that concept. Maybe the fixed deposits were the earlier big thing, and perhaps they were. And when fixed deposit rates have started to fall, and interestingly, Russia was the cause of it. They attacked Ukraine in 2014.
This is that one.
That one. Yeah. After that, the price of oil dropped. Now, it was inexplicable. Why? Because Russia is an oil-producing economy. But at that point, the price of oil fell from the $100, $120 that it was all the way to $30 and $40 for the longest time. Even today, it's at 79 or 80, which is 10 years ago, it was higher. So it's not too bad in terms of inflation from that time. But what has happened over the years is because of the lack of growth of oil as this thing, and the general more interest in India from both a foreign investor perspective, FDI coming into startups that have gotten us more foreign exchange. The rupee's depreciation in the last decade has been of the order of 3.5% versus the 5.5% per year. So it's been even annualized from 2000 to now, it's about only 4% a year. At lower inflation, you have lower interest rates. At lower interest rates, you have lower FD rates. FD rates fall. And guess what? Becomes more attractive. So I'm going away from real assets like gold and real estate. I'm going into something that is a financial asset. I look at a fixed deposit and say, yaar, ye 6%, what the hell? And then I say, forget 6%, I want something higher, and look at equities, and equities are doing better, and equities have done. I mean, we are in this is the 8th consecutive year we'll be profitable at the index level if the market closes. This is December 5th. We have another 20 days or 25 days of trading.
You of course just jinxed it, but nonetheless.
I hope I have. I mean, if market has to fall another 14% by the end of this month, I will stop making podcasts.
Let's not go.
Maybe it will go, yes.
Okay, but that actually leads me to my next question. Fine. But I think that was this point. You've had 8 full years, almost as you said, of positive returns. Even the 2020 I saw on your chart is actually a mildly positive year, despite that madness in the middle. So are we just one crash away from everyone turning away from equities in general and any of the particular avenues in particular?
I would have thought that, because honestly, I saw this in 2007, 2008 when markets fell brutally in 2009. They fell 60%. We saw a massive outflow from both the PMS and the mutual fund industries. When the market fell in 2013, the mutual funds did see some kind of a fall. But since then, falls have only been met with more and more mutual fund activity. And maybe I can talk about some of the other macro reasons now why this has kind of come about. Let me talk to you about just October this year. October this year was a minus 2.5% month. In a minus 2.5% month, and September was already negative to a certain extent, you would expect that there will be some moderation. People will stop buying, they will start redeeming their funds and so on. But the answer is 19,000 crores, out of which 16,000 crores was SIP, systematic inflow flows, has moved net into mutual funds. That means this is not just the gross purchase minus gross sales is equal to net. So that much has moved in October alone. Now, November is a 5% month for the Nifty itself. It's not a negative month, so you'd expect even more money to come in. But in a negative month, to get a 19,000 crore inflow sounds weird. Through COVID, when the markets fell 40%, we actually saw more retail interest than less. Of course, this could be a result of people sitting in their homes and still having jobs, but it could, also be a result of the fact that the ownership potential people got excited about it, and then they watched as markets recovered so strongly that the 20 to 21, if you miss that 1 year, you miss the entire euphoria of, you literally, if you ignore what happened in those 3 months of 2020, the stock markets have been phenomenal all the way from 2019 perhaps till now. So if you look at it from that perspective, it sounds like this particular time, like you say, it seems different. This fall and the people's reaction to this to a fall has been surprisingly bullish. They've been more like, listen, if the market falls, I'm going to invest money. Not if the market falls, I'm going to take out money. That seems to be what's happening. And even though there was been the Ukraine war, there's been Israel and Gaza situation, there have been two banks, one of which is larger than HDFC Bank in the US, collapsing and having to be rescued. You've had all of these situations in just the last 1.5 years, and yet you don't seem to have a meaningful crash or a meaningful slowdown in retail investments into mutual funds. I think this has 3 other sub-aspects to it. One is there's a significantly larger disposable income in India, and one of those disposable income issues has been earlier that India has always been on this fringe thing. So the people who earn more than 10 lakh rupees were considered super rich and all that stuff. Now, the number of people earning 10 lakh rupees, I think, has grown by 30% CAGR over the last 3 or 4 years, simply because as an economy, we've grown. And the 10 lakh number I'm using because 10 lakh is where the highest tax bracket starts. So the number of people in the highest tax bracket has grown exponentially in the last few years. People have more disposable income. People are therefore able to invest. India, by nature, is a saver. So in the sense of every person in India looks at, okay, can I save money first and not spend? Versus America, people have been more conditioned to spending first and then saving. India does not like to take too much debt. They like to save as much as they can and save for marriages. And I'm talking about the relatively affluent class, because at the lower economic strata,
debt is your only way.
Debt is your only way out. So every little expenditure puts you more into debt. I was getting my house painted. I was talking to the painters, and there was this guy from Muzaffarpur, and he was telling me about how he had to work in the city and he hates working in the city. So I said, why don't you go back to Muzaffarpur? He said, I will go back tomorrow because I get up in the morning at 5. We walk in the fields. It's very healthy. I can be there for hours in the fields. Even though it's hot, I breathe clean air and I come back and I have my lunch and he was telling me why he doesn't drink tea. He said at 5 in the morning, nobody wants to make tea meaningfully. And then at 11 in the morning when I come back home, it's too hot to have tea. So I was looking at him saying, my goodness. And that's when we were having this discussion. And then he tells me this thing about, I said, why are you here? Why aren't you there? That sounds like, Jannat, if you may. So why? So he looked at me and said, when in COVID, my uncle fell ill and he died. And my aunt is alone, so they have nobody else. So I have to take care of them. They don't have children. My mother fell ill and we had to take her to hospital, and the hospital fees, to pay the fees, I had to end up taking a loan from local whatever. And that debt is so high today that if I'm not in the city, I can't repay it because there's nothing in the village for me to work in. So interestingly, though, for them, they are not mutual fund investors by a long stretch of imagination. Well, however, if jobs start to move there and things are slowly creeping in, right? So you're slowly growing economies from the larger cities to a trickle down into some of the smaller cities. So hopefully this will be a point where some of the smallest cities in India, smallest pin codes you've never even heard of, will start seeing inflows into mutual funds simply because there is a small set of disposable income layers that are being developed over there. However, to now, I think it's going to be Bombay, Delhi, for the most part, Bangalore, Hyderabad, who are going to still contribute a chunk of income. But the incremental the improvement in the disposable income in these cities contributes substantially to mutual fund inflows, because here the affluent class is a saver class. The affluent class is a person who or a set of people who have now moved away from the real assets of mutual fund or of real estate and gold, because now they understand that the avenues to save. In fact, the government has made now debt funds less attractive. So today, yes, you could get 8% in a debt fund, but people are looking at it and saying, today, when I get out, I'll be taxed at 30% or 35%. Why should I invest in this? Instead, why don't I invest in equities where the taxation is only 10%? So there is a little bit of a tax arbitrage in that sense.
Two quick things. I think they belong here. The first one is I've been to a lot of investor presentations which have alluded to that Muzaffarpur example, where as people cross a certain threshold of income as a country, we have a lot of people crossing a threshold of income. I guess it's not 10 lakhs, it's probably lower than that. But there's a lot of goods that will start getting consumed a lot faster. So the pitch here was that there's going to be explosive growth in some of these, like CPG, I don't know, maybe even FM, so on and so forth. Financial services was only one of them. So one question, do you think investing, given that we have a savings culture to some extent, investing is likely to grow even faster than many of these? So that's one of my questions.
This is actually quite interesting, because I think this is true, because I think the savings culture plus discretionary surplus has big bearing on, where the money goes, and that money will go into mutual funds. Also remember that till now, investing through these instruments, or people wanted to invest in stocks. They heard of stories of investing in stocks and all that stuff. But this investing through a mutual fund was almost like, this mutual fund versus that. What's the difference? But now the regulators have gotten their act together and said, listen, we can allow these people to advertise as a collective. So AMFI comes out with mutual funds ads saying mutual fund Sahi Hai. Now, any mutual fund cannot directly say employ a celebrity. You can't employ Sachin Tendulkar, MS Dhoni, and say buy my fund, because the government frowns on it, SEBI frowns on it and says you can't employ like celebrities to do your marketing. But an AMFI can. So the AMFI can hire an MS Dhoni to say buy mutual funds. And when people look at that, they don't say buy HDFC mutual fund or buy, hopefully a Capitalmind mutual fund if it comes. But they actually say buy mutual funds. And then you go in and say, what are these mutual fund things? And then they've gone ahead and democratized a bunch of things. They've said all mutual funds produce NAVs on a daily basis. Fantastic. There was a time when they didn't. So I'm just saying and the NAV is actually reliable. So if the NAV is 100, the mutual fund has to give you 100 rupees if you sell that mutual fund on that date. So they've ensured that. They've created platforms that say, well, NAVs are published. Anybody can buy any mutual fund if they go through registrar and it's called an RTA, registrar and transfer agent. There are two big RTAs. Earlier there were 10, and they've come down to just two, CAMS and Carvi, or called K-Fintech now. So CAMS and K-Fintech, if you're registered at any one of them, you could buy any mutual fund that is serviced through Carvi or CAM or K-Fintech. Through CAMS or K-Fintech. You're actually in a point where you say that the distribution is automatic. Now, if I want to build a new website that can automatically sell 10 different mutual fund houses, I don't even have to contact those mutual fund houses. I can just register on one of these platforms with CAMS and Carvi and say, listen, I want to start selling them. I can do this. They've created a direct model as well. So you've created the regulatory infrastructure that builds trust both at the sophisticated investor level and at the small investor level, created mechanisms that make people see the money much faster. Remember earlier, 30 days to get the money back if your investment failed. Today it takes maybe 1 day to 3 days, max 3 days. Your third part that's actually happening, and this is the CPG and other things, is that people have started to realize that there is a value to investing. I mean, I could invest in any stock. And there was a time in which people would be like, why should I need a manager? I'll just go and buy these 4 or 5 names. But those 4 or 5 names are no longer the sacrosanct names in the industry. You could have bought a Walmart in the US. The Walmart of those days in 2000 is not the biggest company in the US today. It's not grown significantly at all. It's the same in India. The greatest company names that you know of that have produced wealth in the past generation are not the names that are producing wealth in the current generation. So there's a value to a skill of investing. And people have started to realize that they probably don't have that skill. There's a reason that people don't invest is also because of time. Now, if you invest directly in stocks, you have to be there between 9 and 3:30. In COVID, it was great because you're just one screen away from trading. But now they're telling you to come to office, and then how do you go to office and then log into your brokerage account from somewhere? They've blocked it in the office. You got to do it on your phone, and your phone decides that at that particular time your little app crashes or something like that. You're like, dude, forget it. I don't want to deal with this stuff. So your problem is time. Your problem is skill, and the third one is inclination. Your inclination to do this is also, I talk to people, they look at me and say, oh, well, balance sheets. Deepak, what is this? Profit and loss statement, cash flow statement, promoter ownership, shareholding patterns. What are all this stuff? I don't want to know. I don't like this stuff. If you're forcing me to learn all of this stuff, you'll take. Can you tell me, like, can I just see a list of good mutual funds that have done well in the last few years? And can I just buy them? The answer seems to be, okay, you know what? I don't have the skill. I don't have the inclination. I don't have the time. And because of that, I want to just hand it over. This process, this thought process of saying, I don't mind paying 1% management fees and we charge 1%. It's like, if you have 1 crore of rupees, you're hiring an employee to manage that for you at 1 lakh rupees a year, 8,000 rupees a month. That's less than you probably pay your maid who comes and works in your house every day. And this person is looking at your portfolio every day, deciding whether they want to buy stuff, whether they want to sell stuff. It is ridiculously cheap to do this at a 1 crore size. And it's even more cheap if your portfolio size is smaller. So mutual funds get popular at the less than 50 lakh level. PMSs get popular beyond 50 lakhs. AIFs beyond 1 crore. Simply because people have started to realize the value of this, I think.
Glad you brought that up. Which type of instrument is good for whom? Is it all just how wealthy you are? The wealthiest people all flock to AIFs, which I don't think is the case, right? So who does direct investing work for? Who do mutual funds work for? PMSs, AIFs and the like.
So I think, let's put it this way. It's like, so when you get up in the morning, some people are grumpy and some people are chirpy and out there, right? And through the day, your mood changes over time. So you're not the same grumpy person that you were in the morning all day. And you're probably not the same chirpy person that you were all day. So there are different phases of you. And I think your investing life is somewhat like that, in the sense that you need a part of you that will go and directly do stocks because that part is exciting. And many people start off that way because they think, okay, that's the way to start. They learn eventually that, listen, and I don't understand this stuff well enough. Markets move up and down. I can't deal with the volatility. Why don't I give it to a mutual fund? It seems to be less volatile. So you start off with the direct stocks, move into mutual funds, and then do a little bit of SIP on mutual funds. Somewhere along the line, you'll generate enough capital and say, listen, I like the concept of a PMS where you have a fairly good understanding of what the manager's thought process is. They seem to do better than mutual funds in a lot of ways, maybe performance-wise, maybe philosophy-wise. And mutual funds have restrictions. For instance, they can't invest more than 10% in a certain stock. They have to do the large cap funds have to do only large caps. There are flexi cap funds, but some of them have so much money they end up being large cap funds just because of the 55,000 crores of AUM that they have. So you end up with this situation which says, listen, I'm going to find this PMS manager and give him a certain portion of my money. So that's great. AIFs happen for the people who, once they grow beyond a certain point, you look at an AIF manager and say, the guy says, well, you know what, I have even better strategies for you, but this requires me to take on leverage and take on a bunch of more stuff. So you graduate there. So some people go down this path. Some people may go only in the direct stocks path down, all the way down to, I will do more direct stocks. I will take leverage. I will take a loan against my stocks to buy more stocks. And then I will just stay with stocks. I will never go down the mutual fund road. But I think most people will end up having this portfolio of a little bit of this, a little bit of that, and as they grow richer, they might even become angel investors, VC investors, and things like that. The people who'll broaden their ends of the spectrum. What is right for a person, I think, sometimes depends on the taxation specifics. You can go through those, but the more importantly, it's about the ability to have your money locked in for slightly longer terms of periods of time. Allows you to invest into vehicles which demand those longer terms. A PMS typically should be evaluated on a 3-year perspective, not a 1-year perspective. AIF probably even a 5 to 7-year perspective. So you end up with the ability to have that kind of income that is not required for a longer period of time, and then you start seeing those longer term returns. And I say this as we run a PMS, we run an AIF, so we are very biased. So, but we would like to say here that the availability of capital and the fact that you don't need it just because you have an operation, because you have other capital available for that stuff, that is what I think is a determining factor whether you should invest in X or Y.
This makes sense that it's an and. Like the wealthier you get, it's not that one instrument clearly dominates or is superior than the others. Each of them starts serving a different purpose for a different, say, exposure or something to that effect. And I think that makes sense because if you know what you're doing, you can probably, as a ultra HNI, make a lot of money and save a lot of tax through mutual funds. But on the other hand, there's certain things you can only get through AIFs, or there's certain types of ownership that you'd rather do through the PMS and so on. Of course, as we've also, I don't think we've brought it up here as much, is that there's some type of people who have restrictions on stock ownership for whom PMSs don't work. But anyway, that's for another day. I do feel a blog post or an article on this might be very helpful if you can painstakingly go through who is what good for. I am actually trying to contrast this with my experience in, well, now no longer firsthand, but a little bit of the experience from the US, where I was at least a bit shocked when you were doing the prep, and at the beginning of this podcast, you talked about how the mutual fund AUM in the US is still significantly higher than that of ETFs. I almost thought you were off by a zero or something, but anyway, leaving that as it may be, my understanding of the US was mutual fund is all legacy because, as you said, it's like from some 1930s or something. ETFs are passive and kind of are the future, and everyone is essentially buying ETFs. Although, as our colleagues keep telling us, sometimes people charge you 1% for the privilege of buying ETFs, which is, well, whatever. It is what it is. But I thought that the dichotomy there is, look, you either do passive in the form of all these various ETFs. I know they're active ETFs as well, but you either do passive or you do direct stocks. And that's basically how life is in, say the US, as an example. Do you feel that's the same, I mean, the Indian market is looking the same way, and that this is how things are going to evolve here as well?
This is actually a very interesting point. I think we've had a podcast on the direct versus passive versus active.
Probably more than one.
more than one, yeah. And we keep talking. So, let me start with the US wala differences. The reason why US mutual funds have been unpopular, and I think there are two big reasons. One of them is that there's an actual tax disadvantage. One of the tax disadvantages is that if the mutual fund sells a stock in the US, a mutual fund, there is a tax component of that sale involved. That tax component is paid as income tax to the government. But what the mutual fund does is they send you a bill saying, listen, thank you for owning 1,000 units of our mutual fund. We bought and sold a lot of stocks, and the gain ascribed to your ownership is $425, and therefore please consider $425 as your capital gains income, and please pay tax on it to the US government as it may. We have reported to the US government that we have $425 of gains in the mutual fund ascribed to you. Now, you have no choice but to pay the tax at this point. So you're pretty much saying that the incremental, intra-year buy and sell, which in India is not taxed at all to anybody, is taxed in the case of US mutual fund to the end investor. The capital, the transaction, the gain that is generated. Of course, net of that, the capital gain is after when you actually sell the mutual fund and so on. This fact does not apply to an ETF in the US. This does not apply to an ETF at all because they do a complex structuring at the end of the year or in the middle of the year, which involves some kind of a large transaction in and out, which kind of wipes off all of these capital gains transactions that have happened in the middle of the year, which allows, and ETFs, they never buy and sell stocks. Essentially what you buy, when you buy a stock of
this is in the US.
In the US. So the ETF itself does not buy and sell stocks. What it does is it says, I will give you a bunch of units. If I have to create a new bunch of units, I will create a new bunch of units. You give me a bunch of stocks. So if I give you 1 unit, give me so many stocks of X, so many stocks of Y, and so on. So typically they'll say, listen, I'll give you 100,000 units. Please give me so many shares of A, B, C, and D. And it's an exchange, and therefore there is no transaction, if you may. And in the end, when somebody wants to redeem an ETF, the same in India as well, they redeem the ETF by giving a bunch of units to the ETF, and the ETF does not give them cash. They give them the shares corresponding to that many units of ETF shares. What this does is essentially say that there's no capital gain because you've just kind of exchanged units for stocks, and there's no capital gain per se, and therefore there's no... So effectively, an ETF's only transactions will be, the weight of this particular stock has changed from 5% to 6%. You seem to have 5%. Please buy 1% more. That's the transactions they do. A mutual fund, on the other hand, will be buying and selling all the time. So there's a difference in that. That structure, therefore, advantages an ETF more in the US compared to a mutual fund, and therefore people flock more towards ETFs because net gains are much higher, effective gains. Second thing that disadvantages them is ETFs, although they have costs. So sometimes, for instance, for a person to advise you to buy an ETF, he may charge you 1% of your assets. Technically, this 1% is weird because, you could select your own ETFs, but by and large, most institutional or advising frameworks charge you between 1 to 1.5%. In India, people not just advise you, they actually will buy stocks on your behalf, manage your stocks, do all the work associated for the same 1%. But here in the US, for advising you to buy an ETF, they will charge you 1%. But that is still cheaper substantially than a mutual fund. A mutual fund average cost may be as much as 6%. There are mutual funds with entry loads of up to 6%.
Oh, okay.
So that means you've paid 6% just to get in. So different classes
That
of shares.
sounds like India from many decades ago, as you were saying.
Yes. So that time it used to be 4.5%. Now it's about 6% in the first year, and then more per. So given this, the active mutual fund class in the US will suffer and continue to suffer. While they have $22 trillion today, and ETFs are only 6.5 or 6.8, I believe that the ETF industry will eclipse the mutual fund industry over a period of time. The mutual fund industry continues to lose capital on a monthly basis. But the US, it's interesting because the US also went through this phase where mutual funds got extremely popular. And even with those high costs and even with relatively less popularity of ETFs, the US was seeing $1 billion to $2 billion a month in ETFs in
10 years ago, 15 years ago?
25 years ago, in 1998. There's a book by Maggie Mahar called
Was that
Bull.
ETFs?
No, sorry, it was mutual funds. It was
mutual
not,
funds. Okay.
So the mutual fund net inflows were of the order of $2 billion a month. And today, we're seeing 16,000 crores a month, which is roughly $2 billion. Which is what India is right now. So we're at 25 years ago, perhaps, compared to the US. But where the US mutual fund and ETF organized fund industry went is to much higher levels than direct stocks to that extent. So you went into a phase where mutual funds actually rose to a tremendous extent. People start to realize that the costs of these mutual funds are very high, both from a taxation perspective and also from a entry load and annual cost perspective. They started moving away to ETFs at some level or direct stocks at another level. Compare that to India, where the institutional framework is actually more tax advantage to stocks versus direct investing. Remember, in the US, you have to pay a fee whether the mutual fund sells a stock or you sell a stock. In India, if the mutual fund sells a stock, you don't have to pay anything. And if you sell a stock, you have to pay capital gains tax. So the mutual fund has more of an advantage in India than a mutual fund does in the US. And to that extent, we don't see that going away between a direct stock and a mutual fund, where you're saying, oh, well, you know what? Mutual funds still have the tax advantage. There are still forms of institutional capital. There is still so much lack of information in the marketplace that I think active managers have considerable alpha compared to, say, an index or even just inflation as a measure. India's growth story is in the early phases of it and so on. But the other aspect of it is direct versus passive versus active. And we've done
so let me try and I think we do sound a bit different, I think, from what my recollections are of our take on this a few years ago. But here's my question to you. What did you say? Mutual funds are 9%, PMSs are maybe 1% or whatever, AIF, I don't know, or equity AIFs, not so much. If you were to take a prediction on over the next, say, 5 years, will this take off, or will the market share of active instruments or active vehicles like these grow from 9 to something more or less? Because I also think it matters how you view asset management companies in that line.
Actually, this is a great point. Now, let me start with the basic framework. I think India's disposable incomes will continue to grow. The rich will at some point get richer, and I think the poor will also get richer, but perhaps at a slower rate. But both cases will generate disposable income at some levels. In the US, money market mutual funds are very popular. They own 30 trillion, I don't know, some crazy crazy number of $1 trillion of assets. They are used. In fact, today in India, it is possible. Banks give very high rates on fixed deposits for a year or so. But in the US, fixed deposits for a year also are at relatively very low rates. So people switch into money market mutual funds because they give you better rates of interest. India, the differential is not so much. So I think that move will happen when banks start to realize that, listen, these people are not going to break their fixed deposits no matter what. So let me give them lower and lower interest rates, where comparatively a mutual fund, a money market mutual fund or a liquid mutual fund may actually yield a much higher rate of return, in which case, you'll see some of that switch happen. But I have a greater theory here. There are two things over here. First, look at the numbers. 360 lakh crores of Indian market cap. Roughly 25 lakh crores in mutual funds, less than 10% perhaps of all assets owned by this single mutual fund. Our GDP is 250, 260, 270 lakh crores, let us say. Of that, even that is about 10% of GDP in mutual funds. The US has about 120% of GDP in stocks, maybe 140%, but 70% of its GDP is in mutual funds. Whether they're active or not is not the relevant part of but I think over here we've got that. I think that part of the game keeps increasing going forward. So from the 10% we will go to the 20%, the 20% will go to the 40%, simply because more and more people get richer. And there are three things, as I talked about, skill, inclination and time, and more people start to realize this. But there's another realization that dawns on me. So for instance, the longest time in the past, we should I've written this in the book, in my book, in a different way, but there are two kinds of income, right? There's active income and there's passive income. Active income is you work for it, so you get a salary. This is the worst tax part of things, because they deduct your tax, give you money, then you spend it. Then the next level higher would be of active income would be to run a business. You can run a business personally, you can create a private limited company, you can create an LLP, whatever it is, you earn some money. You spend some money. The government realizes that you need to spend money to make money, and they allow you to spend some money, and then the remaining is what is taxed. So you effectively spend before you're taxed versus after. And I think you mentioned that you've also...
I remember hearing this in Rich Dad Poor Dad book some decades ago. But anyway, so coming to your point.
It's an interesting reason why it's effective is that your taxation is lesser, and you get more alternatives. Businesses can hire people. It's helpful for the economy because you mostly provide either services or products which are useful to grow the economy per se. As a salaried individual, you contribute, but you contribute in a very different way. You don't have the same leverage to the economy as much as a business has. So these are the forms of active income. Now you might say, listen, we want some passive income. There's rental income. You can buy a house and take rent off of it. Rental yields are almost next to nothing. You have to make money only on the appreciation of the house, and then there's a lot of things like somebody can take away your house and not pay rent, plumbing issues and stuff like that, which hurts you, painful. There are instruments like gold, where hopefully sovereign gold bonds or certain bonds and certain fixed income instruments which give you returns. But by and large, India's inflation has fallen to a point where India does not need interest rates to be very, very high anymore to counter the aspect of inflation. And therefore, I think interest rates will be low enough to discourage people from putting too much money. At least post-tax, the returns fall to below 5% for a lot of people. And it's not very exciting on that front. What do you do then in terms of active income? Now, here's an interesting aspect, and I say this a lot. So when you're running a business, you earn 1 rupee, you make 1 rupee. That's how you earn money. But when other people run businesses, how can you take a part? Now, if they actively let you have a part of their business, which they're running, but they just have capital, they have effort, but they don't have enough capital. And they're saying, listen, I need some money, I'm going to do an IPO, I need some money, I need to take a QIP or whatever it is. They give you a portion of their business. Now they're running it, you're effectively employing them, but you're not calling them your employees, you're just calling them the founders of the companies who you own. They're earning every rupee, and the market decides to give them a P ratio of 20. That means every rupee that they earn translates into a 20 rupee increase in market cap for you. Effectively a 20x leverage, a different form of capital appreciation, which is a multiplier of wealth. If this is something that is now put in this manner, and therefore you're only also participating in economic growth. You're also, but if you have that massive leverage of this 20x of every rupee of earnings coming to you in the form of returns, then participating in any company that's growing gives you that additional passive income, and this seems to be the most interesting source of passive income for people going forward, until a point comes where India becomes a boring country where you can only grow at 4 or 5%, and once in a while you'll get on Amazon and Microsoft that grow at 30-40, or Nvidia that grows at 100%, but you will by and large find companies that are really, really boring. So great ROEs, great ROCs, but growing at 8% a year. We're not yet there. I think we won't be there in the next decade. So what happens now? Take this, marry this to the point that I want to participate in companies. I don't know how to. I don't have the time to. I don't have the inclination to even learn. But I know by and large that this is a way to make a lot of money. I will give my money to active managers or passive managers. I think less passive than active right now, because the active space is not so crowded that because there are so many companies in India that are yet undiscovered. There are passive stories that will continue to haunt. I mean, the largest cap companies in India are going to be passive.
Or there are factors other than momentum that people aren't really investing in. Just saying.
Yes. So yes, I mean, we should say this. And it's honest. It's so crazy that even something as simple as momentum works so well in India, simply because the nature of the markets is to promote fear and greed, and therefore some people who prey on the fear part of things, they have been utterly disappointed after 8 years of positive growth in the markets. I'm sure the fear elements have come a lot less, which is why Warren Buffett is almost like, guys, where are my opportunities? So because you don't get that many opportunities anymore. But the greed part and harnessing greed is something that momentum does so well, and so passively in a way, in the sense that saying that I don't really have to marry the companies I'm buying and so on. But these kind of thought process, they're so early for India. India is in the beginning stages of, I think, a multi-year greatness in the asset management space, and in the way that companies way that institutional capital can be pooled and managed. We have problems. For instance, if I said, Shrey, you and I start a company. You're really good at investing in companies. I'm going to give you my money. Let's put it into a company format, and you just invest it, together. It's
like
a pool.
Mini Berkshire Hathaway.
Mini Berkshire Hathaway. It's not allowed, because you create a private limited company that does this. Some auditor will raise a note saying, listen, more than 50% of your assets are
NBFC.
Financial. You need to please go get an RBI NBFC registration. You go
Never
to
happened.
RBI says, who are you?
Get
Two
out.
people company, get out of here. We don't even want to talk to you. So your issues are like, listen, you can't do it. And if you want to do it, they say get a license, and you're not going to get the license. So what do? That company still has the money, and you're sitting in the specter of, no, somebody will come after you. They'll put you in jail because you're running an NBFC when you shouldn't be running an NBFC, but you can't get a license of an NBFC because so this concept of not allowing these private little pools of capital, who's going to come in the way if you and I are creating a company and we're investing? Am I going to go? What am I going to go and say? I gave Shrey my money and he invested it in capital and lost it. I completely understand that, because I know
SEBI gets these complaints. Actually,
I'm sure they do, from a perspective of, but you can't say that, oh, there's somebody who complains that someday somebody honked too loudly, so can you please ban all honks on cars? I wish that happens one day, but that's a different point. But I think you still need honks on cars, because there will be situations where they're cows, and you can't.
They don't react very well to these horns anyway. But I think where I'm hearing you go is that they're all going to grow. I mean, active is looking very favorable at the moment, which may or may not have anything to do with the fact that there's a bull market. But the fact is that all of these vehicles are going to grow, and asset management companies have a lot to gain from this, and people are going to invest, whether it's active, passive, a combination of all of these. And this, as an industry, this is going to grow a lot. And as investors are going to put a lot more money into all of these.
I say this with a very biased view, because we're in the industry, right? So, but I'm looking at this and saying, isn't it obvious for the whole world to say, pools of managed capital, whether it's a PMS, whether it's this thing, is simply going to be the future, because the skills are not widespread. Not everybody understands how to invest in these instruments, but everybody wants the money that's made from these instruments. So how do you participate in a meaningful way? Yes, I could invest my own money. Today, the most flexibility is given to me to invest my own money. I can do F&O and options and intraday trading, which institutions in India cannot do. However, or they can do in a very limited fashion. But this is going to change, and as this changes, it's going to allow people to do. In the US, there's something called inverse ETFs. You can bet on something falling rather than just something going up. In India, you can't institutionally bet. You can do a personal bet. I can personally bet on some company falling, but I can't take an institutional. I can't buy a mutual fund that says, well, the market's going to fall from here, so I want to make money when the market falls. Those instruments are going to come as the market gets bigger and bigger and bigger. There's so much out there that I think we're in the early stages of. We're in the process of building markets. We haven't even seen the beginning of bond markets of any meaningful size, but we haven't even seen the beginning of equity markets of any meaningful size, because we have like 50 companies, out of which 20 determine how the index, not even 20, it's 10. If you take just the top 10% companies of the index today, they're going to determine almost how the index moves in the next 1 year, and it'll be the same 10. It's not, maybe every year the exact 10 may change, but roughly by and large, those 10 companies pretty much determine the index. You buy them, you've got the index. You don't buy them, or you buy something else, and chances are you've lost. The aspect of that becoming more and more secular. The US has an S&P 500. India has a Nifty 50. And I think we can get to a point where our larger number of our companies will determine the course, or will participate deeper in the course of our economic growth. So if that is the case, if the economy itself is growing, the more companies participating, the more people, the more is like, this is famous in You Got Mail, choices scene, where this woman wants to go, or this guy, I forget what the exact thing was, but the point was about just ordering a coffee, and then you get coffee with low foam, low fat, cappuccino, and it's no longer just coffee anymore, right? It's just choices. There's so many choices. And once you get so many choices in an economy, in a market, in a set of companies, you're going to need someone to sit and say, listen, I can figure this out for you. This is an intermediary, but that intermediary is necessary because you don't want to do the work. It's the intermediaries are going to get cheaper and cheaper and cheaper. India is already one of the cheapest. And as a PMS charge 1%, which was unheard of when we started off the PMS, but now it's commonplace among all PMSs. Mutual funds, which used to charge 1%, now charge 0.5, simply because they've reached economies of scale and they're managing 50,000 crores. So at 0.5%, you're still making 250 crores, and how much are you going to pay the fund manager? So at some level, you're making those economies of scale. Asset management companies grow simply because there's more capital available. It's not foreign capital that's coming in that's primarily driving all of this. It's domestic capital that seems to be driving this. And the richer we get, the richer we get. And so I think more assets to manage.
So $5 trillion stock market far before $5 trillion economy.
I believe so. I think $5 trillion, well, interestingly, the 5 trillion number is going to get very complex because of the rupee. It just keeps changing, right? It was 70, it was 5 trillion was 350 lakh crores. We would have gotten there, except the rupees at 80, now 83. So it's now 410 lakh crores that we need to obtain. But you're right in that the economy is greater than of course, GDP is a value measure and stock market capitalization is a stock
flow
measure.
Versus value.
Flow versus stock.
Okay.
So effectively, it's like saying, listen, all the houses in the country, if you sold them, the value of the houses would probably be greater than the GDP of the country and probably greater than all the money RBI has ever printed in its life. So the point is that, you don't even have as much money as is available in the real estate of the market. But we also know that if anybody tried to sell all the houses, forget of a whole country, but even of a locality, the prices would drop to 1/10, because if everybody's selling, then nobody's buying, and effectively, it's over. The game's over. But that's not the point over here. Is the stock value is going to always be greater than the realizable value at some point. So the economy will trail and has to trail I know that I differ on by some very famous people who feel that if the GDP is less than the stock market capitalization, that it should be a bad thing. My point is, it doesn't make any difference. They are not related numbers. 5 trillion in market cap should easily be available. And given that our promoters own 50% of the company, you're just valuing the remaining 50, which is actually tradable at substantially lesser than GDP. So I think, 5 trillion gets there on market cap far before 5 trillion on GDP.
Thanks a lot for that, Deepak. Well, everyone, thanks for listening. If you like what you heard and would like to hear more about how we think about investing, then do visit capitalmind.in to read more about our articles that talk about our investing process and research. If you're interested in investing with us, our website capitalmindwealth.com has details about our portfolio management service, or PMS, where with a 50 lakh minimum investment, you can open an account with us. And if you have any ideas or feedback about the podcast itself or suggestions for future topics, then please email us at podcast@capitalmind.in. Thank you.